Welcome to our channel, where we provide valuable insights and expert advice on finance and economics to help you become rich. Warren Buffett, the world's sixth richest man, has proven that he knows how to win when it comes to investments. Buffett has done something many other investors have failed to do. He's consistently turned a profit over the years through careful analysis, research, and planning. He has been able to predict which businesses will succeed and which will fail, resulting in billions of dollars in profits over his lifetime. So how can you emulate the success of the Oracle of Omaha? Here are some of his investment strategies that will help you be successful when it comes to investing in stocks, commodities, real estate, and more. Early days. Warren Buffett was born in 1930 in Omaha, Nebraska. His father was a stockbroker and a congressman. He grew up during the Great Depression and used his own life experiences as motivation to not only make himself successful, but also help others. After graduating from high school, Buffett went on to study under Benjamin Graham at Columbia University before transferring to the University of Pennsylvania's Wharton School of Business. There he studied under David Dodd, who became one of his most influential professors. Finding his niche. Buffett found his niche in the investment world by being a value investor. His success came from his keen ability to analyze the market and invest in companies that would turn a profit. He says, to find an undervalued asset is one of the most important things in investing because it can turn into something much more valuable over time. He also diversified his investments, so he wasn't putting all of his eggs in one basket. This strategy has helped him gain success because he was able to invest in many companies at once, and even if some stocks crashed, others would make up for the loss. The birth of Berkshire Hathaway. Berkshire Hathaway was founded in 1955 by the merger of two companies. One company was a textile manufacturing company, Berkshire Fine Spinning Associates, which had been merged with another textile company, Hathaway Manufacturing Company. The name Berkshire came from the name of the county in Massachusetts where both companies were located. The two companies merged in 1955 to become Berkshire Hathaway. The other company, National Fire Insurance Company, was primarily an insurance business and had agreed to merge only because they needed the money due to unexpectedly high claims. After the merger, National Fire Insurance Company became National Indemnity Co., while Berkshire Hathaway took over what remained of both businesses as well as their subsidiaries, more than 60 in all. His advice for success. Warren Buffett's advice for success in investment is surprisingly simple. He advises that investors should stick to what they know. This means that, instead of investing in a company or industry with which you are unfamiliar, invest in something you know about and do your research. For example, if you grew up in the U.S., invest in companies based here as opposed to those abroad because you're more likely to understand the risks and benefits associated with them. The second rule of investing is also very important, which is patience. It often takes time for investments to make any return on the original investment, ROI. The last piece of advice Buffett has is that one should not be afraid to lose money. His investment strategies. Warren Buffett's investment strategy can be summed up in a few key points. Number 1. Value investing is the core of his strategy and is based on the belief that stocks are undervalued when they trade below their intrinsic value. Number 2. He looks at stock performance, not just at what the company sells or earns, but also at how its competitors do. Number 3. He looks for companies with consistent earnings over time and low stock volatility. Number 4. He prefers businesses with products or services that are necessary or desirable and that have high barriers to entry. Number 5. He typically invests in companies where he can purchase shares at prices below what he believes they will eventually be worth. Number 6. His portfolio consists of stocks from companies of different sizes, from well-known blue-chip corporations to small, unknown startups. Conclusion. Warren Buffett is one of the most successful investors of all time. His investment strategy is simple, but it works. Invest in what you know and buy low when everyone else is selling high. The key to his success was his dedication and patience. He did not let short-term disappointments or other people's opinions interfere with his long-term goals, which made him a wise investor. After he made his decision to start investing in stocks, he learned everything he could about stocks by reading newspapers, magazines, and annual reports. And he took the time to study how they were priced on the market. Through this research, he developed an understanding of how stock prices move up and down over time. Armed with this knowledge, he invested wisely through both the bull markets, when stock prices are rising, and the bear markets, when stock prices are falling. Thank you for watching, and be sure to subscribe and check out our other videos for more insights on economics and finances.